Hello and welcome. In this introductory module, we're going to pull back the curtain on a subject that is fundamental to how the world works: accounting. Now, I know what some of you might be thinking: accounting, spreadsheets, numbers, but I want you to start by thinking about it differently. Think of it as a language, a powerful, universal language that tells the story of any business, from a local coffee shop to a global tech giant. Our goal is to help you learn how to read, understand, and use that story. Let's make this practical. Imagine you have a fantastic, game-changing business idea. It's easy to have the idea, but the real questions come next. How are you going to get the funding you need to start? Once you're up and running, how will you truly know, if you're profitable or if you're just busy? And just as importantly, how will you communicate your success and your vision to convince talented people to work with you or to persuade investors that your idea is the one they should back? The answer to all of these critical questions lies in accounting. So, who is this story for? Well, almost everyone. Investors, both current and potential, need this information to decide: is this company a good investment? Should I buy their stock? Creditors, like banks, needed to answer a simple question: if we lend this company money, can they pay us back? Managers inside the company are constantly using this information to make strategic decisions. Are we operating efficiently? Are we making a profit? Even customers have a stake in this. They want to know if the company will be around in the future to honor warranties or provide support for the products they buy. As you can see, this language has a very wide and very important audience. At its core, financial accounting performs two primary functions, as you can see in this diagram. First, accountants must measure the business's activities. They systematically collect and process vast amounts of data about everything a company does. But data without context is just noise. So, the second, equally important function is to communicate that information to decision makers. Accountants are the bridge. They take the raw activities of the company, measure them, and translate them into standardized reports that allow those investors, creditors, and managers to make informed decisions. Theory is great, but let's make this real. For the rest of this lecture, we are going to build a business together. Let's say our goal is to create a top-tier soccer training academy, which we'll call Eagle Soccer Academy. After doing our homework, we determined that we need about $300,000 in startup capital to get this academy off the ground. Okay, so where does the $300,000 come from? This first step is called financing. Typically, there are two main sources. First, we can get money from investors. These are owners. We decide to sell 10,000 shares of stock in our company for $20 a share. The money we receive from this, the $200,000, is called contributed capital, or more specifically, common stock. Second, we can get money from creditors or lenders. We go to a local bank and secure a business loan for the remaining $100,000. This loan is not ownership. It's a debt that we have to repay. In accounting, this is called a liability. Now that we have the money, we can introduce the single most important concept in all of accounting. I call it the golden rule. Your textbook calls it the accounting equation. It is the bedrock on which everything else is built. It states that a company's resources must always be equal to the claims against those resources. The resources a company owns are called its assets. The claims on those assets are divided into two types: the claims of creditors, which are called liabilities, and the claims of the owners, which are called stockholders' equity. This equation, assets equals liabilities plus stockholders' equity, must always remain in balance, no exceptions. Let's apply this golden rule to our new business, Eagle Soccer Academy. we raised $300,000. Let's say we kept $180,000 as cash and used the other $120,000 to buy soccer equipment. So our total resources or assets are $300,000. Now, who has claims to those assets? Well, the bank has a creditor's claim for the $100,000 it loaned us, that's our liability, and the owners, our stockholders, have a claim to whatever is left over, that's their stockholders' equity of $200,000. And look, $300,000 in assets equals $100,000 in liabilities plus $200,000 in equity. The equation is perfectly in balance. All right, we're set up. Now it's time to open our doors and start training soccer players. This is where we move from financing to operations. And this brings up a new question. How do we measure our performance to know if we're profitable? We need to track two key items. Revenues. This is the money we earn from our customers for providing our service, in this case, conducting soccer training sessions. Expenses. These are the costs we incur to operate the business, such as paying coaches' salaries, renting the fields, and buying supplies. To report our performance, we create our first financial statement, the income statement. Think of it as a financial report card for a specific period of time, like a month or a year. The formula is simple. Revenues minus expenses equals net income, which is another name for profit. For Eagle Soccer's first month, let's say we earned revenues of $72,000 and had expenses of $58,000. That means we generated a net income of $14,000. That's a successful first month. This is an excellent position to be in. We have a $14,000 profit. Now, the owners have a choice to make about what to do with this profit. They can pay it out to themselves in the form of cash. A cash payment from profits to stockholders is called a dividend, or they can choose to keep it in the business, reinvesting the money to buy more equipment, hire more coaches, or expand. Profit that is kept in the business to foster growth is called retained earnings. This decision leads us to our second financial statement, the statement of stockholders' equity. Its job is to show exactly how the owner's value or equity changed over the period. We start with the equity we had at the beginning, which was the $200,000 our investors initially contributed. We then follow the formula. We add the net income for the period, which was $14,000. Then we subtract any dividends paid out. Let's say our owners decided to pay themselves $4,000 in dividends. This leaves us with an ending equity of $210,000. The owner's claim on the company grew from $200,000 to $210,000. And now we come to the grand finale. This is the most beautiful part of accounting, where you see that these statements aren't just separate reports. They are an interconnected, elegant system that tells a complete story. Watch the flow here. First, we have the income statement, which generates our net income of $14,000. Now, follow arrow number 1. That very same $14,000 of net income flows directly into the statement of stockholders' equity, increasing the owner's claim. The statement of stockholders' equity then calculates the ending balance of stockholders' equity, which is $210,000. Next, follow arrow number 2. This ending balance of $210,000 flows to the balance sheet, becoming the official equity figure there. Finally, look at the statement of cash flows. It details every dollar that came in and went out, calculating an ending cash balance of $137,000. And for the final link, follow arrow number 3. That ending cash balance of $137,000 is the exact amount of cash reported on the balance sheet. Every statement is mathematically linked. They all work together. So, let's quickly recap what we've learned today. First, accounting is the language of business. essential for making decisions. Second, the accounting equation, assets equals liabilities plus stockholders' equity, is the unbreakable foundation of financial reporting. And finally, the four primary financial statements don't exist in a vacuum. They are interconnected and tell a cohesive story. The income statement shows profitability, the statement of stockholders' equity shows the change in owner's value, the balance sheet provides a snapshot of financial position, and the statement of cash flows explains the movement of cash.